Hello and welcome to Halifax America's tutorial on building a portfolio of automated trading systems. This presentation is part of Halifax America's Algo IQ services, which is a moniker for our services pertaining to algorithmic strategies and algorithmic focused education and consultation. We hope you enjoy this presentation. So we have three goals for today's presentation. The first is to show you one approach to building a portfolio. Bear in mind that there are many approaches to constructing a portfolio. We're just going to show you one approach, and we're going to do it through demonstrating how we would do it based on certain criteria. So the second goal, of course, is to demonstrate through building one ourselves. Now, the third goal is something that we're going to be following up on a weekly basis. We're going to track portfolio performance based on the portfolio that we had constructed today. When building your portfolio, the criteria you establish is critical. It establishes your performance goals, it defines what is favorable and unfavorable, and it also sets benchmarks for your portfolio evaluation. We'll get into this in more detail. For example, we've identified a set of 5 criteria to help us build our portfolio today. The first one is diversified markets with low correlations. We want to make sure that the instruments we include in our portfolio are in different markets and that 2 or more instruments don't trade in exactly the same way. In other words, they have low correlations. Number 2, we want to make sure that the maximum historical drawdown is less than 35%, which is a pretty aggressive figure, but that's what we've decided to use today. Number 3, we want to make sure that the annual ROI is about 20% or greater. Number 4, the profit factor should be positive. In other words, there should be more made than lost on average if you were to calculate the average of all trades. Number 5, we want to make sure that the mathematical expectancy is positive. To satisfy our first criteria, which is diversification of markets, we've decided to build a portfolio that includes one system trading the E-mini NASDAQ futures, that's a US stock index, another system which trades the DAX, which is a European stock index, another system that trades gold futures, and yet another that trades crude oil futures. So you have US stock index, European stock index, metals, and energies. Let's take a look at our first system, which trades the E-mini NASDAQ. This system can be found on our Halifax America Algo IQ page, which includes over 400 systems, so we had to apply filters to find the exact type of system we were looking for. You'll notice that the worst drawdown, historical drawdown that is 5,975. Relative to the suggested capital of 20,000, the maximum historical drawdown is about 29%, which satisfies our criteria of keeping the max historical drawdown below 35%. Okay, it also has a positive profit factor of 1.28. That means 1.28 to 1. And it has a win rate of about 45.8%. Now, that means that it tends to lose a little bit more than it gains. But that doesn't really give you the entire picture. You have to run a mathematical expectancy formula to see, well, is it in the long run potentially positive or negative? A mathematical expectancy formula is a little bit more complex, and we'll discuss that in another tutorial. For now, all you need to know is that if you run the stats through a mathematical expectancy formula, that it is above 0. Anything below 0, it's negative or projected to lose in the long run. Anything above 0 is considered positive and potentially a profitable system. Now, that depends on a number of other things, including market dynamics. We won't get into that. Of course, you know that there's always risk in any form of trading, and that you cannot predict the future, you can't predict the markets, but you can project reasonably, or rather based on reasonable statistics, reasonable expectation. After all, it's all speculative. Okay, so That was quite wordy, but the important thing to note is that the drawdown matches our criteria, the profit factor is positive, the mathematical expectancy is positive. So this will be our first system, and we're going to be tracking this along with the other systems that we select for this portfolio. The second strategy in our portfolio trades the DAX futures. It has a maximum historical drawdown relative to suggested capital of about 32%, which still satisfies our criteria of keeping the maximum historical drawdown below 35%, has a positive profit factor of 1.57, and it has a win rate of about 47.3% and a mathematical expectancy of about 226.24, or rather 226.24, which is well above zero, and that's exactly what we're looking for. For our third system, we selected an algorithmic strategy that trades gold futures. The worst historical drawdown relative to the suggested capital is about 23.9%, which is below our 35% limit. It has a positive profit factor of 1.83, and its frequency of wins versus losses is at about 61.3%. It also has a positive mathematical expectancy of about 141, which is well above zero. And for our final system, we decided to select an algorithmic strategy that trades energies, in this case, the crude oil futures. Its worst historical drawdown relative to suggested capital is about 34%. It's just reaching the limit that we set for ourselves of 35%. Its profit factor of 1.52 is positive, and the frequency of gains versus losses is at 50.4%. The four systems that we had just selected will comprise our entire portfolio, and we're going to be tracking this on a weekly basis. Before we conclude this tutorial, I wanted to briefly touch upon performance. There are a number of algorithmic strategies listed on our Algo IQ page. Some of the strategies are relatively new, while others may have been trading for quite some time. You'll notice three color-coded boxes at the bottom right of the stats to help you identify periods in which a strategy has been backtested and tracked, indicating hypothetical performance, and periods in which a strategy has been trading live, indicating performance with real capital investment. The strategies we selected for our portfolio include a mix of hypothetical and live results, meaning that there are periods reflecting performance with real capital, as there are periods in which performance has been tracked or backtested. Now, why did we select strategies combining real and hypothetical performance? In our experience, the correlation between live and hypothetical results will vary. Positive live performance does not necessarily indicate that it will continue to perform well, hence the commonly encountered disclosure, past performance does not necessarily indicate future results. While at the same time, every profitable live strategy started at some point in time as a theory whose only positive indications may have been grounded on hypothetical results. All trading, whether hypothetical or live, is speculative and can never be considered predictive. And this is something that you should always keep in mind when investing in any speculative strategy. So thanks for viewing our tutorial video. There will be plenty more to come. As for our portfolio, we will present the results on a weekly basis. If you have any questions, please email us at info@halifaxamerica.com. And feel free to visit our website at halifaxamerica.com. Thank you very much and have a great week.